Here's the top 10 high income list I shared on November the 12th. I just sold Arbor Realty Trust and Hive. Today I'll explain why I sold them and what I replaced them with. I've reviewed a lot of income stocks and funds on this channel, and if you're new, it's difficult to know where to start. So I created this top 10 list to simplify things. I own just over 30 stocks and funds, but these 10 are the ones that I'm most heavily invested in and the ones I think would have the widest appeal. For example, Hercules Capital and Southwest Capital are both excellent BDCs, but Southwest's loan portfolio is diversified across more sectors. So that's why I gave Southwest the spot. Also, this list actually pays more than the average yield shown here. Maine, Southwest, and Blackstone have been paying out special dividends, and those aren't shown in these numbers. And that's because special dividends are less consistent than regular dividends. If you want to learn more about any of these 10, I created this playlist so the reviews are easy to find. And for regular viewers, the studio looks a little bit different because I'm building a new one. So excuse the sawdust. I'll be using some AI for temporary decor, especially here. That's not actually real, but we'll press on. Get rid of that. Let's dive straight into recent changes. I just sold ABR, which sounds crazy because I concluded the short seller attack video by saying the report wasn't credible, so I'm not selling. I also said that I'd like to understand Arbor's exposure.
As an investor, I'd like to read an analysis of Arbor's loans and their exposure and the likely outcome, but unfortunately, I don't find this document to be credible.
So I went looking for a better source of information, like somebody who's not a short seller. I found 3 articles that did a good job of explaining the challenges facing the multifamily sector. There's always demand for rental apartments, so long-term, multifamily is generally a good investment. And the issue isn't quite as simple as high interest rates. We've had those before, obviously. The problem is the speed at which they increased. When interest rates went up like this, developers had years to adjust. When they increased at this pace, developers were blindsided. There are a few other factors, and they're explained in the 3 articles. I'll link it in the description. As for Arbor Realty Trust, I was combing through the comments on Seeking Alpha, and I found a link to this article from Value Investors Club. It's way too long to cover in this video, but the author has been a member of this group for 12 years and has been writing articles there for 11 years. I read a few of them, and I didn't sense any hidden agenda. Unlike Viceroy. The article explains in detail the rising interest rate issue I mentioned before and the recent shift in rental rate growth. It's basically slowed down a lot. Now, this isn't irrefutable proof that Arbor is in trouble, but it's far more credible than the Viceroy report. So my advice for Arbor investors is to read the articles I just mentioned and draw your own conclusion about whether to invest in it. The CEO of Arbor, Ivan Kaufman, mentioned several times in the last earnings call that there are serious challenges ahead. Interestingly, he just bought over $400,000 worth of shares, and the CFO just purchased over $100K. So that is a positive sign that they believe in the long-term future of the company, which is good. But after weighing everything up, I've decided to err on the side of caution and sell my Arbor stock. Specifically, I'm doing that because I'm concerned about a potential dividend cut sometime in the next 12 months. The timing sucks because the Viceroy report hurt the stock price. However, it was also the catalyst for me to look deeper into the business. Once Arbor navigates the next few challenging quarters, I'm open to buying back in because I like Ivan and I like the company. Next up is another investment I really liked, but recently, not so much. Simplify's High Fund, HIDH, has been paying a yield in the high 9s while maintaining a reasonably steady price. When the market became choppy, High used its fairly conservative option strategy along with the yield it was earning from treasuries to offer a safe harbor during stormy days. I like seeing this when the market was red. This was the 2-week period after I released the High review video. It was doing its job, which is minimal price volatility. But sometimes the option trades take small losses. Over the 8-month period since March, those small losses have exceeded the gains. I've been waiting for it to bounce back over $25, but it hasn't happened. This is a price chart, by the way, but when we switch to a total return chart, which includes the dividends, the return is less than the 9.6 yield I signed up for. And if we look at the total return for the past 2 months, That's exactly zero. Unlike ABR, the downside risks for this fund are fairly small. I'm not worried about major dividend cuts or the price crashing. If the price recovers to $25, I'd take another look at it. By the way, if you're new to the channel, I retired in 2017, and that's when I got serious about researching my investments in greater depth, because now they pay for everything. I mostly focus on stocks and funds paying consistent yields of around 8% or more. Let's switch to more positive news. I recently bought PBDC. This is a fund that invests in business development companies, or BDCs. It's been a fantastic year for BDCs, but there are about 50 of them, and it's a lot of work figuring out which ones to buy. They're not all good. You can spread the risk by investing in a fund that holds a basket of BDCs. The most popular one has been BizD, B-I-Z-D, or B-I-Z-D. It's been around for 10 years, and it holds about 25 BDCs. As I discussed in this video, it's an easy way to diversify, but it's an index fund. It blindly follows the MVIS US Business Development Companies Index. I'd prefer an actively managed fund where the portfolio manager sells the overvalued BDCs, buys the undervalued ones, and avoids the risky ones. The video mentioned a new fund that does exactly that, PBDC. So let's take a look at how it's been doing versus BizD. It's just over a year old, so we don't have that much data, but so far it's outperforming BizD. And for context, it's also outperformed the S&P 500 over the past year. The distributions are variable, but have been averaging around 10%. The fund currently holds 21 BDCs, but the top 10 holdings are what really matters because they make up 75% of the fund. And looking through this list, I personally own the top 5 holdings in the fund, so we obviously have similar taste. I haven't had time yet to make a video about Blue Owl, but I do like it. And there are reviews of these 4 in the BDC playlist on this channel. So I've mentioned the major positives. What about the negatives for this fund? Well, the fund fee is 0.75%, a bit on the high side, but not that unusual for a small, specialized fund like this that's actively managed. They only have $41 million under management, so that's only $300,000 in fees. By the way, you may see some crazy high fees like these, around 6%. Just ignore that. It's an SEC rule that applies to BDC funds and counts internal expenses from the holdings as fees. I'll include a link for a full explanation in the description. The other concern I mentioned in the August video was liquidity, specifically the bid-ask spread. My purchase went through at the same price quoted on Yahoo Finance to the penny, so I didn't have to pay a premium because of low trading volume, but it is something to keep an eye on, so if you have any doubts, just use limit orders. The fund is growing slowly but surely, so as it gets bigger and older, I think it's going to become a better investment. I allocated about 2% to PBDC and will probably add more if the price drops. After the recent run-up, it's not exactly cheap. The next fund I bought hasn't had such a great year. PFFA has suffered under high interest rates for 2 reasons. Firstly, it specializes in preferred stocks. These behave somewhat like bonds in that their price moves in the opposite direction of interest rates. Secondly, it uses 20 to 30% leverage, and the increased interest expense has made the fund more expensive. Total fund fees, including interest expense, are 1.4%, which is not cheap. Aside from the 10.5% yield, I bought this fund for 2 reasons. Firstly, I think the performance will improve when interest rates eventually fall. Who knows when that will be? Secondly, the exposure to a basket of preferred stocks gives me some extra diversification. I'm not as enthusiastic about this one compared to PBDC, and I only put 1% into it. The Fed pivot might take a while, during which time this fund may languish a bit. A few people asked in the comments why SVOL, S-V-O-L, isn't in my top 10. SVOL has had an excellent year, and I continue to hold it. However, you don't get a 16.5% yield without risk. It's a complicated fund, and I wouldn't want to suggest it's a safe 16.5% that everyone should hold. If you understand its relationship with volatility and you're comfortable with the risks, then it might be for you too. Before I show you the updated top 10 list, here are 2 special promotions for Armchair Income viewers. The first one is a Black Friday special. Regular viewers know that my primary resource is Seeking Alpha. I don't buy a stock or a fund without first checking it on Seeking Alpha. I uploaded this YouTube community post recently that explains the promotion, but I have no way of tracking how many of you actually receive those posts. So if you didn't receive it, just an FYI, The Seeking Alpha Black Friday promotion expires on December 5th. I won't go into the details because people will see this video after December 5th and the information will no longer apply, so I don't want to upset people. So just click the link in the description and you can get the details. It's a good price. The second update is a follow-up to the invitation I made in the How to Find High Yield Investments video.
The other websites that I mentioned, I'll put down there too. They're not affiliate links, but I guess they could be. So Contrarian, REIT Forum, Systematic, if you're watching and you want to offer Armchair Income subscribers a discount, send me an email and we'll set it up.
Well, after that, the REIT Forum has been in contact and they've offered Armchair Income viewers an exclusive offer. To give you some context, the REIT Forum is for investors who want deep research on individual preferred stocks, BDCs, equity REITs and M-REITs. For those categories, it goes far deeper than Seeking Alpha. I realize a lot of you are mostly focused on ETFs and it doesn't cover those, so it's not for everybody. It also doesn't cover mutual funds, MLPs, or closed-end funds. But for those of you that do want deep research on these categories, the link in the description will get you a 10% discount. I searched the internet high and low, and this is the best price I've seen anywhere for the REIT Forum, including their own website. So that's an exclusive just for viewers of Armchair Income. Here's the updated top 10 list. The average yield has fallen slightly to 9.9% because the market has been on a tear lately, and to a lesser extent because of the removal of ABR. As I explained in the last video, I reinvest some of this yield to keep the income growing. Speaking of growing, BDCs have been growing their distributions this year. If you'd like to learn more about PBDC and other BDC funds, check out this video. That wraps it up for this top 10 update. More Armchair Income coming soon.